know today was ugly. I'm not so worried about this decline because it's become increasingly clear that we're dealing with a whole new market. The last month and a half has been truly fantastic for a host of high-quality stocks. I guess you probably would have called them one time the blue chips. Yep, after spending nearly a year in the doghouse, we've had a nice run since mid-October. Back on October 13th, the major averages put in their most recent low. This was a day where we got a slightly hotter than expected consumer price index reading for September. After initially opening lower, we looked under the hood, realized things were getting better, and the market put on a major rally. Fast forward to November 10, we finally got a cooler than expected consumer price index number, and the whole market soared, with the averages putting in their best single-day performance since the spring of 2020. But this rebound is not evenly distributed. That's the key point I want to make right now. From the respective lows on October 13, the Dow Jones Industrial Average has soared a remarkable 18%. S&P 500 has gained 14%. Tech-heavy NASDAQ's only up about 10%. That's the new pattern. See, the Dow leads, everything else lags. We saw it again last Friday when the Dow gained 0.5% while the S&P was off slightly. You might have been like in a turkey-induced coma, but the NASDAQ lost 0.5%. If you look at the course of this whole year, it's really rather amazing. Dow's only down about 7%. S&P lost nearly 17%. NASDAQ tumbled more than 29%. Talk about where not to be. Now that we've only got 5 weeks left in the year, it's worth thinking about why the Dow's been holding up so much better than the other averages, and whether it can continue, frankly. I think this is the most important story of 2022. The Dow was the last of the major averages in the stock market. The Dow was the last of the major averages to peak. Its top came in January, not last November, when so many of the high flyers peaked. And it was the first to bounce back. On Friday, the Dow made its highest close since late April, when Wall Street started freaking out about an inevitable recession as the Federal Reserve ramped up its rate hikes. We basically erased these losses. Look at this. We've erased the losses. That tells you something, doesn't it? Nobody's talking about it. Remember, as I've been saying for roughly a year, tech is ground zero for this decline, and it's not going to change this week. Richly valued software-as-a-service stocks, financial tech stocks, newly minted IPOs, SPAC names, these have all been eviscerated as Wall Street turned against growth. This is the first group to feel the pain in a high-inflation environment where the Fed rapidly raises interest rates. We just hadn't seen such high inflation in so long, so we didn't know what to do. First, because growth stocks are the most vulnerable to inflation. Look, if you own something that trades on its potential future earnings down 10 years, right, 10 years down the road, well, inflation makes those future dollars a lot less valuable, doesn't it? Second, these unprofitable companies are the ones that most desperately need to raise more money. And when the Fed tightens, it's so hard to borrow or sell equity.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.